Mortgage interest rate volatility continues for this week and actually hits an all-new time high. Let's go ahead and discuss what happened this week in mortgage interest rates for the week of the 26th through the 30th right after this. Well, welcome back after the break, everybody. Mike Petras here, your Star Realtor of Star and the Treasure Valley, back with another weekly update of what happened with mortgage interest rates from the week of September 26th through the 30th. Now, as mentioned in the intro, as a brief overcap, the volatility remains. Honestly, rates just kind of went all over the place, but they did hit an all-new high, reaching into the sevens at 7.08% this week. Did we see a little bit of relief over the last couple of days? Yes, but let's go ahead and dive into why that happened, and let's go ahead and dive into what we can expect coming up. All right, so what happened this week? Let's go ahead and let's just dive right into it by taking a look at the 30-year UMBS, or Unified Mortgage-Backed Securities, sitting at a 5.0 coupon. And again, I've beaten the dead horse with the word already, but volatility was the key word. Come Monday on the September 26th, the UMBS, the 30-year, definitely took a huge hit. Really kind of just stemming, again, across from last week and all the volatility that was happening, and really the defensive positions that everybody's kind of putting themselves in when they're selling off their stocks, bonds, and even here in the UMBS. So Monday really hit, and that is when we actually saw the highest number that we had seen all week. And actually we've seen since 2002, which was an interest rate of above 7% at 7.08%. So that was really a big hit. But as we take a look at the 27th and 28th, and as we know, when the value of the UMBS goes up, the mortgage interest rates are going to go down, and then vice versa. When the value goes down, the mortgage interest rates are going to go up. And we can see some relief here on the 27th and the 28th. Well, why really was that? It was because actually the Bank of England had things to do with this. So from their massive sell-off that they had over there in England, the Bank of England decided to go out there and start buying up their bonds, their mortgage-backed securities, which really kind of floated it. And even though this is a geopolitical world that we live in nowadays, that actually did filter into the United States, and investors again start turning around and say, well, might as well kind of follow what they're doing, and they started buying it up. The Fed didn't do that, but it was investors that came through, or at least I haven't seen any data that the Fed was the one that actually came through and did it. But we did see some relief on the 27th and the 28th. But again, here on the 29th and even today, we're still seeing the UMBS lose some value. So again, interest rates are remaining volatile throughout the course of this week. And can we see that leading into next week? I'll get into that in just a second. So let's go ahead and take a look at what happened in the 15-year UMBS. Again, a little bit of relief today. You can see that it went up 0.06 of a point. And but over the week, as we kind of go along, again, Monday took a huge hit. That's when we saw record numbers in terms of the actual mortgage interest rate that we haven't seen since 2002. Again, some relief on the 27th and 28th. Why? Mainly because of the Bank of England. And then on the 29th, it took a hit. And then today, a little bit of relief in the UMBS 15-year at the 5.0. So let's just go ahead and dive into where the numbers are today as of Friday, September 30th. It sits for a 30-year fixed at 6.79%. Today it came down 0.03 of a point, but over the week went up 0.09 of a point, and over the month we're still sitting at 0.84%. A 15-year fix is coming in at 6.08%, down 0.01 of a point today, but up 0.08 of a point overall for the week, and then over the month 0.84 up. 30-year FHA is sitting at 6.50, basically unchanged, but over the week went up 0.25 point, and over the month 1.20%. 30-year jumbo sitting at 5.85, down today by 0.05 of a percent. For the week, down actually 1/10%, and then for the month up 0.8%. For a 5-and-1 ARM sitting at 6.05 today, down 0.07% today. For the week, down 0.07%, but over the month, up 0.12%. And then for a 30-year VA, we're sitting at 6.60 today, up 0.05 of a point. Over the week, up 3.35%, and then over the month, up 1.25%. So briefly looking at the Treasury yields, let's go ahead and start off with the 10-year Treasury yield. We can see the volatility throughout the course of the week. It's kind of going up and down and up and down. But today we do see that the price changed a bit. It actually lost almost a full point, just sitting at 0.625. Price change coming down. And again, just like the UMBS, when we see the price go down, people start selling off their treasuries. We can see that the yield is going to go up. And in this case, that is what has happened today. And if we look over the course of the week, again, just pointing out the volatility. But the main key here too is still, even though the Fed has come up and they have started, increasing the FFR, which really kind of affects the 2-year Treasury more than it does the 10-year Treasury yield, we could still see that the yield in the 2-year is way above the 10-year. So the Fed has still got some work, because we know that the FFR will affect the short term more than it's going to affect the long term down the way. So we can see, though, the 2-year Treasury yield is still making gains and is still inverted as we go along, which is indicating recession. And if we're just kind of taking a look, it might take a little bit here for the 5-day, but I just want to point out that it's been almost just as volatile over the course of the week. And today, actually, we have lost 0.1953 on the price change. And of course, again, as the price goes down, the yield is going to go up. But again, volatility as we have gone over the week. Now, when we get volatility, we get, say, inversions that come month over to month, as we're taking a look in the monthly aspects of it, then that is also an indication of recession. Not so much when we're kind of just doing day over day or week over week, but it's just something we'll have to continue to pay attention to as we go along. But both yields have been really volatile too, as well, in the bond markets. All right, and lastly, let's briefly just kind of dive through what happened in the stock markets this week. And as you can see, again, volatility even in the stock market, but generally it is still on the way down overall throughout the course of the week. In fact, the Dow Jones right here lost 2.75%, down 811.33 points over the course of the week. NASDAQ is going to follow the same suit. Again, volatility, but again, down over the course of the week at 2.38%. Down 257.77 points. And if we're going to go ahead and take a look at the S&P, again, I know S&P is definitely in a bear market, but down 97 points throughout the course of the week and down 2.64%. So the stock markets are feeling it, the bond markets are feeling it, and overall the UMBS is feeling it. And why is because really the Fed does not have control over the inflation here in the US. And that is really scaring all of the markets. They're taking out their money. They're holding on. And they just don't have the faith. And really, is the Fed being aggressive enough right now in order to combat this inflation? Actually, the answer to that question is no. And here's why the answer to that question is no, is that if we go ahead and we take a look at the PCE index of what they primarily look at, and say we're looking at the core PCE, which excludes food and energy, which is one of the things that they look at, we can see that it's still making gains. If we look at the PCE price index, you can see jumped up from what we had last month. If we look at the core PCE, jumped up. Okay, so in other words, the prices here in the US they're still on the rise. And we know that when we're going to the grocery store, we know that when we're going to the gas station, we knew that with everything that we're doing right now. And so the Fed really is not still being able to tackle this. So when I'm taking a look at the PCE, you would think that today there would be another big sell-off that would happen because of this report that came out. But really what happened, and it's really kind of been able to hold true for today, is because they put themselves in such defensive positions. All these investors put themselves in such defensive positions over the last 3 weeks that really this PCE report is no big surprise. Not like the CPI report that came out about a week and a half ago now. So either way, the markets really kind of put themselves in a position to take this blow, but we'll see what happens next week as we go along. And that's something we're gonna have to continue to watch, is if the markets are going to react harder to this PCE report. So what maybe should we expect next week when it comes to mortgage interest rates? Well, first off, I mean, the PCE report really didn't seem to have an impact. Have they really put themselves in defensive positions enough to where this is not really a big surprise? We're going to have to go ahead and wait and see to see if there's any fallout from the PCE that happened. Well, next week, though, we do have the ISM, which is usually manufacturer productivity reports coming out. Plus, we have a jobs report coming out. So we're going to have to pay attention to that too and see if that's also going to create more volatility in the market or create even another sell-off down the road. So we're just going to have to wait and see. I actually anticipate the jobs numbers to maybe be on the way back down, which could be a good thing, you know, for investors if they're taking a look at that. But in terms of the ISM, the productivity, I almost kind of see that it might really remain the same, you know, and if it's going up a little bit and still, you know, saying like, hey, we're doing really strong here in the US, that could be another thing that could trigger a possible sell-off. So we'll just have to wait and see, but expect rates, I would say, to remain volatile next week, if not potentially even go up. But we'll go ahead and we'll take a look at that coming up. Well, thank you very much, everybody, for watching this video. I do hope that you found the information useful. And please continue to watch these videos, the weekly mortgage interest rate updates, because they're really going to kind of keep you in tune to what is going on. And then, of course, I give my predictions as it goes along. But also, I do invite you to watch some videos that I will post at the end of this, including Mikey's monthly market update, which talks about the real estate market right here in the Treasure Valley at the end of this video. And even I'd like to recap again and have you watch what Jerome Powell said during his last meeting. And of course, the next meeting is coming up in November. We'll just have to see what the Fed is going to be willing to do. But again, I just want to go ahead and tackle, is this a bad time to buy? And again, the answer to that question is no. And why is that going to be the case? Because buyers, there's a lot of inventory out there for you, and the buyer's demand has definitely cooled off right here in the Treasure Valley. So what does that mean for you? That means that you can actually go out and get the home of your dreams that you are looking for with little to no fight, like say that we had a year to a couple of years ago. So that is definitely a key thing right there. Also, we have been seeing price reductions all over the Treasure Valley on all active listings. So that means that you're actually going to get a reduced value or reduced price on the home that you're looking for. Plus, on top of that, we could probably still go in and be able to negotiate for further price reductions. But also, the main thing is that concessions have returned to the market generally. And concessions are sellers willing to pick up your closing costs or are willing to be able to provide you concessions to do like 2-1 buy downs, etc. And of course, as I mentioned, I believe that the recession is here, and it's only a matter of time before the effects of the recession actually hit. And what happens when a recession hits? The mortgage interest rates will come back down historically. So that means you can go ahead and refinance at that time for little to nothing or even free. So it is a win-win-win situation for buyers right now. Even though it doesn't feel that way, it really kind of is. So if you'd like to know a little bit further about that, or you're looking to buy, sell, or invest right here in the Treasure Valley, feel free to reach out to me. I can be reached at 208-715-STAR. Again, that's 208-715-7827. And if you're looking to begin your home shopping experience today, please visit my website at www.yourstarrealtor.com. Also, if you're looking to move in from out of state right here to the Treasure Valley, please click in the description link below. Download my free relocation guide so that way you're in the know before you decide to make the move. Also, please hit that subscribe button below, click on the notification bell, and please comment below. Love to definitely hear your thoughts on where you think this economy is going to be going and what do you think is going to happen here in real estate and mortgage interest rates as we go along. So I look forward to that day that we speak, everybody. Thank you again for watching this video. I look forward to that day. God bless. Until then, look forward to calling you my neighbor. Till the next video. Bye-bye.